Now, corporate governance. See, corporate governance basically what it means. It is all about managing the business, right? That means adopting such process or procedures to manage the affairs of the company which comply on three parameters: fairness, honesty, transparency. Actually, fairness, accountability, and transparency. But we can say that corporate governance is a procedure by which affairs of a corporate are being managed with regards to fairness, honesty, and good practices. Of course, it is not going to benefit only the company, but it is ultimately going to benefit all the stakeholders. So, corporate governance, if you adopt these processes in managing the affairs of the company, it is going to be beneficial for all the stakeholders were around. Right. Now, what is this corporate governance? Okay, fine. There are certain procedures or there are certain processes that we have to adapt. Is this procedure complied or written in law? The answer is yes. A lot of corporate governance procedures have been imbibed in law to make it mandatory for the benefit of all stakeholders. However, there are there is still a lot of scope of fair practices, honest practices, good practices for the benefit of all stakeholders, which might not be made mandatory in law, but which are the thought processes of upper management, and it flows down throughout the company, which is called as the top down approach. Okay, so it is about managing a company with regards to fairness, honesty, and good practices. Who manages any company? A company is being managed by the board of directors or the shareholders, right? Ultimately, it is being managed undoubtedly by the board of directors only, but shareholders also have certain decision making powers. So, mainly, they are responsible for the governance of companies. The governance can be good or bad. Of course, good governance, when we talk about it, brings good image, reputation. It helps in good finance, trust in the company, and ultimate growth of the company. So, corporate governance normally applies at the top level, as I explained to you, and it flows from top to bottom, which is also called as top down approach. Now, see, corporate governance is the main motive, or you can say, when we talk about the objectives of corporate governance, it is all about bringing transparency, bringing more justified policies for all the stakeholders. Right. Corporate governance aims at bringing an ideal composition of board of directors, because they are the ones who are ultimately responsible for governance of companies. So if there is an ultimate ideal composition of board of directors, ultimately there will be fair practices in the company. Right. If there is corporate governance, then there will be optimum use of resources. Resources means all the type of resources. There will be reduction in risk management. Okay. And undoubtedly, you are going to develop a strong relationship with your customers, with your suppliers, with the government, with your employees, with everyone. So there will be a strong relationship of the company as well as all the stakeholders. So it brings about transparency, it brings about good management, it enhances the value of enterprise, it makes people accountable, it helps in more innovation, it helps in bringing professionalism in the corporates, and it also incorporates, or all the stakeholders are also contribute towards the company, right? Now, ma'am, is it similar to what we call as ethics? No, ethics are an individual choice, right? And everyone has an individual choice. So a manager also has an individual choice, and so is a peon who is working. However, when we talk about corporate governance, we have to adopt the policies which are being developed by the corporate. So it normally applies at the top level and it flows from there, right? Ethics emerge naturally, but corporate governance is studied, experienced, evaluated policies which you develop over the period of time for ensuring fair practices in the company, right? So in ethics there are no regulations. However, in corporate governance there are regulations which are involved, right? In the same manner, it distinguishes management also from corporate governance. Management is different. Management also applies at all levels. However, corporate governance applies only at the top level. Right. Regulations are not important in management, but in corporate governance, regulations are very important. Okay. Corporate governance is not about achieving any result. However, managers are focused. This is our target. This is our target. This is what we have to achieve. So, managers are all about achieving a particular target. However, corporate governance is the process. You have to achieve the target, that's a different thing. But corporate governance is about fair method of reaching, fair method of that procedure, fair method of managing a company towards your target, right? So methodology of achieving results is more important than the actual result in corporate governance, right? Now corporate governance has been evolved because of the corporate failures that we have witnessed, because of more investors being participating in the market, and especially institutional as well as retail investor. A lot of retail investors have also increased. So the government also want that only secured information is being passed, and that information is should be reliable. So increasing transparency, increasing disclosure, that has led to more evolution of corporate governance, right? So you have to connect with the stakeholders, you have to comply with the regulations, you have a lot of other regulatory requirements also. So considering all these in mind, this is how corporate governance has emerged, and it has a lot of benefits which I've already told you, right? So we discussed about. Now we also have something called as the theories of corporate governance through board management. So we have in total 4 theories which may be asked as a objective question as well as a proper subjective question. Maybe write a short note on, or maybe you have been given a particular situation and this theory is, you may be asked an MCQ also. Stewardship where the directors decide and drive, so they are the stewards of the company. Agency, the directors act as the agent of the company. Stakeholder, we include stakeholders. And trusteeship, they are given authority, and it is all about trust. So they are the relationship of trust established, and they're being handed over a huge amount of money which belongs to the company, right? But there is a relationship of trust which involves over there. With this, we come to the end of our very first unit. We move to the next unit of corporate governance, which is corporate governance practices or codes in India. Okay, so for that we have the very first one, which is Cadbury Committee. Cadbury Committee, or you can say Adrian Cadbury Committee. It was set up by Security and Exchange Commission of USA. So it is not an Indian committee which was set up, right? Any committee which is being set up or which is being formed is for a particular purpose. That okay, fine, you do that feasibility study, you research, and you bring your own recommendations that this should be imbibed in law, right? So they also, every committee comes up with their own set of recommendations. There are many recommendations which have been made mandatory by law as on date, but this is backdated what we're reading. Okay, fine, this particular committee was formed back then. So Cadbury Committee, what were their recommendations? They said that listed companies should have audit committee. We know that it is mandatory now, right? And such disclosures should also be made in the annual report. Whoever is the statutory auditor as well as the finance auditor, they should attend all the meetings of audit committee, right? Other members or other board members may also have the right to attend. And the audit committee is going to discuss with the external auditor about the scope of audit, like which audit firm is engaged and all that part. And the chairman of audit committee will be available at annual general meeting to answer the queries. So these are broadly 4 points which you should keep in mind. Next comes your Rahul Bajaj Committee. Now, this is Confederation of Indian Industry constituted this particular committee. So, it is an Indian committee. Now, it recommended, what were the recommendations? They were very short recommendations that you have to study. The recommendations being that only listed company, okay, with the turnover of either 100 crores and paid up capital of 20 crores have to set up the audit committee, right? Ma'am, both the conditions have to be complied with? No. Lesser, whichever is less, that you have to comply with. And if you comply with that, then you have to set up an audit committee within 2 years when you reach that particular threshold. Now, audit committee is undoubtedly there to assist the board. Then comes your KR Chandratre committee, which is again an Indian committee, and it broadly focused on audit committee only. So companies with paid up capital of 5 crores, they should have audit committee. Now, Audit committee will discuss with the auditors periodically. Audit committee will have the authority to investigate also. So investigation powers will also be given to audit authority, oh sorry, audit committee. Which matters it can investigate? It can investigate matters on its own or those which are referred by the board of directors, right? And then there will be punishment also for non-compliance, which includes imprisonment. And the chairman again of audit committee will be present at annual general meeting to answer the queries. And lastly, we have Kumar Mangalam Birla committee, which is an Indian committee which was set up by SEBI. So this is actually an important one, and you have a lot of recommendations that you have to read about it. It has certain mandatory recommendations and certain non-mandatory recommendations also, which are just recommendatory. Okay, so it came up that this should be made mandatory and this can be made optional or this can be made voluntary. Half board to be independent. Half of the board of directors should be independent, but if the chairman is non-executive, then one third may be independent. Okay, fine. Companies with a capital of 10 crores and net worth of 25 crores. Actually, you can leave this particular point. In fact, I haven't even incorporated this particular point in my charts. Committee will be there for investor complaints also. That means a committee should be formed to which is going to study investor complaints, which we have today, right? We have stakeholders relationship committee, we have nomination and remuneration committee, which is also recommended by this particular committee. Okay, so there will be audit committee which was going to investigate. There will be a committee for investor complaints. There will be a committee for nomination and remuneration, right? And then the chairman of these committees will be present at the AGM to answer whatever shareholder queries they have, right? Then annual report should have a lot of details about the directors which are being appointed. Okay, now the next topic that we have is principles of good governance. So we have a board level and we have below board level. What is board level? Standardized, regulated by Companies Act and loader regulations. As I told you, when we talk about corporate governance, it flows from top to bottom. So at board level, everything has been made mandatory. A lot of things have been made mandatory. Where do we read about corporate governance, which board of directors have to comply with? It is regulated by Companies Act, and also major portion of it is also regulated by loader regulations. Loader, SEBI loader regulations is nothing but it is corporate governance only. But obviously it does not apply to all companies, whereas when we talk about Companies Act, mostly provisions apply to all types of companies, right? So if I say that, okay, fine, if you're a listed company, you have to have a woman director. So that is what? That is a step towards corporate governance only. The loader also regulations also have a lot of content to it. Below board level, every company has their own code of conduct, and undoubtedly they have their SOPs, standard operating procedures, they have their department manuals. So that has been designated or designed at the management level, and it flows from top to bottom. That is top down approach that I've already explained you, right? Now we have certain things that we have to read about independent director also in the chapter of corporate governance. Although you know about independent directors, which you have read under Companies Act, but here also we have certain things, and we'll have a broader perspective apart from what is strictly written in law, right? So independent director, there is a code. We all know that. Schedule 4 of Companies Act 2013 gives us the code which has to be followed by the independent director. How an independent director will be appointed, we already know that. But here we have something else. We have to ensure, apart from the disqualifications, you also have to ensure that he must possess the appropriate skills, and he will be approved at a general meeting. There will be a letter of appointment which will set out his term, his the company's expectation from him, the duties, provision for director and officers insurance if any, and code of business ethics which he must comply with. Independent director should always have high standards of integrity. He should perform his duties. He should do whatever he is doing for the benefit and interest of the company, and he should not involve his personal benefit. So he should keep his professional obligation different or separately, right? he should not do any type of activity which ultimately loses his independence. So he should assist the company, he should assist all the board of directors in the best possible manner, right? So we have certain things from examination perspective. We have the roles and functions of independent director, which we have to read. We have to read about the duties of independent director and the manner of appointment. Manner of appointment, somehow I've already told you. When we talk about the duties of independent director, so duties, independent director should regularly update his skill, take professional appropriate advice whenever needed, attend all meetings, whether they're general meetings, board meetings, committee meetings. He should keep himself well informed, report concerns about any unethical behavior that he comes across. He should not disclose confidential information or unpublished price sensitive information. Okay, so of course there are more points, but these points should be sufficient. Then we have something called as corporate governance ratings. Whenever we rate anything or anyone, it determines his relative standing. See, you cannot say this is A unless you have a D also, right? So when you're rating someone, it determines your relative standing. Okay, fine, this has been rated as B and this has been rated as A. Then on the parameter or on the tenets of corporate governance, this entity is better than this. So this is better. That is the relative standing, right? So it determines the relative standing of an entity with respect to other entities, but we're talking in terms of corporate governance only. We're not talking in terms of any other thing, right? So when I talk about corporate governance, there are certain cases where you have to have these ratings, right? There is also a compliance report which has to be furnished by listed entities. Compliance report on what? Compliance report on corporate governance. So for that also we have different annexures. I think I have, okay, I'll tell you that, right? So we have that also. That is one parameter. There is another parameter that, okay, corporate governance ratings, they help the stakeholders provide a lot of information. They helps to determine which entity is better. That is, it helps to establish the relative standing of an entity, right? It enables the stakeholders to form a better decision, right? And it see, we have three aspects. Although we have a lot of assessment criteria, if we're being asked in examination that there is Mr. Sham, Mr. X, whatever, he is a stakeholder and he wants to know how this particular company is performing on the tenets of corporate governance, right? Or as an employee, if you want to join a particular company, you would be willing to know that, okay, what is the relative standing of this particular company when I talk about governance. So for that, we have three components. When we talk about this corporate governance ratings, we have ESG ratings, which is the similar thing. So we have environment, we have social rating, and we have governance rating, right? So when we talk about environment rating, we check the environmental key metrics, right? And based on that, the rating is given. When we talk about the governance rating, we check about the board governance, who is governing the company. So what is the ideal composition of board of directors? What is the pay that you are giving? Ownership and control, inclusion of stakeholders and all, and accounting about the maintenance, disclosure, transparency, everything. And thereafter, we have social key metrics, which incorporates other things, right? So based on three: social rating, environmental rating, and governance rating. So you may be asked in examination, what are the three types of rating? When you're being asked the types of rating or ESG ratings component structure, this is what you have to write in examination. Now, you may also be asked about the assessment criteria. That means, which points should be kept in mind while you are assessing about the governance of any company. So you should check about the board structure, you should check about accounting, you should check about professionalism, you should check about the disclosure, you should check about the grievances, whose grievances, investor, customer, vendor, how these grievances are being dealt with, how much CSR they are doing, right? How much dividends they are being paid, how much compliance they are doing with the law, right? How much disclosure they are doing, how much they're incorporating shareholders in their decision making, right? So all these points should be kept in mind while deciding about the ratings. Then, if I come about to listed entities have to submit quarterly compliance report on corporate governance to recognized stock exchanges, and there is format which is being given in the annexure. So we have annexure 1, 2, 3, 4. So these are the four things that you have to keep in mind. Annexure 1 on quarterly basis, annexure 2 at the end of the financial year, annexure 3 at the end of 6 months from the close of financial year, and annexure 4 on half yearly basis. In the regular class, I've even shown you these annexures and explained you what these are all about. We move to the next unit, which is corporate governance in family business. The family business is all about where majority voting power is in the hands of the controlling family, like we call Ambanis, right? Now, what happens over here is that you may call it family business, you may call it a family company, you may call it family owned business, whatever you may call it. Here what happens is that the power is concentrated in the hands of family, the power as in the terms of voting, as in the terms of decision making, right? Now this leads to a lot of advantages, and this leads to a lot of disadvantages also. If I prima facie talk about the features of such family owned companies which we have in India, the directors or the senior management are from the family only. The formation of a lot of groups is common, right? Coterie is common. Emotions are attached. There is dilution of shareholding from generation to generation, because we have 5 children, then we have to dilute the shareholding amongst 5 people, right? There will be conflict of interest undoubtedly. In a family of two, there is a conflict. So whenever we are talking about the family owned businesses, there will be undoubtedly conflict of interest. Now the ones who do not belong to the family, that is the non family directors, they're actually defunct in decision making, they're not involved in decision making, so they just have to blindly follow what the family members are saying, even if they're not very much competent or more competent than the non-family directors. Hardcore professionals thus avoid working or joining such companies because they don't feel the worth, right? Even if they have something to contribute, maybe the family is not ready to accept the same. And the death or disability of any senior member leads in management crisis. Why? Because they are the ones who have expert knowledge, they are the ones who are leading a family, and if they die, then ultimately the whole business gets shattered, because there is no one who is competent enough. There may be, right? Even some family members may not have these features. These are the general features, or the common features that we find in family businesses, right? So they may be present, they may not also be present, right? Now, the emerging issues in such businesses are dealt by separation of ownership and management. So now the ownership is in someone's hand and the management is in others' hands, right? So family members are also growing. They're acquiring professional courses from reputed institutes. Their promoters are encouraging more professionals to join the company. The role is being decided at the board level. That okay, fine, this is the role that you have to do. So that role, the person will be restricted to that role only, right? Owners are accepting the decisions of managers. So whatever managers are contributing, the owners are willingly accepting. And you can also form a trust and thereby make your son or your daughter the beneficiary of that trust, so that he gets the benefits but he's not involved in the direct management, which leads to better managing of the company. The next unit that we have is all about CSR, and we also have some guidelines. What are these guidelines? Earlier, we had NGRBC, rather sorry, earlier we had national voluntary guidelines, which is NVGs. Now we have NGRBCs. So here I have written in short 9 points. You don't have to read them in much detail, but of course you should know all these 9 guidelines. Since it is a revision, I'm not taking you to the actual flow of these, but yes, businesses should conduct and govern themselves with integrity. So undoubtedly there has to be honesty, and there should be a manner of transparency, ethical and accountability. You should provide only such goods which are sustainable and safe. We will read about the sustainability. That means you're not compromising, you're not compromising on the future needs or the needs of future generations. So whatever you're using in your business, you have to ensure that the needs of future are not being compromised with. Right. Businesses should respect and promote well-being of all employees. So whoever is employed, if I'm talking about the value chain, it is right from start to the end. So whoever is employed, whoever you're taking help of, whoever is working for you, you should promote the well-being of them. You should respect the interest and be responsive to all of its stakeholders. Supposedly there is a vendor grievance, supposedly there is any shareholder grievance, so you should be responsive towards everyone. You should respect and promote human rights, very important. Make efforts to protect and restore the environment. So emit less industrial waste. Try to bring different ways of recycling. Try to restore environment in the best possible manner. Then sometimes you may be involved in policy making. You may be a part of it. So you should take that in a responsible manner. You should promote inclusive growth and engage with your consumers in a responsible manner. See, it is very important. Whether you're in a product sector or you're in a service sector, if you're providing a particular product, you have to ensure that it should not be hazardous. You should have to take that responsibility towards consumers and ultimately thus provide whatever you're providing, right? After that, we also have something called as CSR. Right. CSR is covered under Section 135 of Companies Act 2013. We all know that, right? Now, in CSR, this is the overview what we read in Section 135, read with rules, and then we also have a different perspective. It's actually extracted from the rules only, but still. Steps in the implementation of CSR, that also we will see. So company which complies with any of the following conditions has to go for CSR. Net worth more than equal to 500 CR, turnover more than equal to 1000 CR, or profit more than equal to 5 CR. So if any of these conditions is complied with, you have to form a CSR committee. And that CSR committee will recommend a CSR policy which board will approve, and thereafter you have to have a minimum expenditure of 2% of average net profits of preceding 3 years as your corporate social responsibility. Okay, what is going to be that expenditure as approved or as covered under Schedule 7 of the Act? However, if your expenditure is not exceeding 50 lakhs, then you don't need to form a CSR committee. What you can do is your board itself can have a CSR policy and they can go for CSR expenditure. You have to have CSR expenditure, but CSR committee is not required. However, if CSR committee is mandatory, then it should be composed of 3 or more directors, out of which at least one shall be independent director. Your CSR policy is going to be placed on the website and also contained in the board's report. How can you implement CSR? That we'll read actually later. If you take any activity outside India, that is not going to be considered as CSR. If you contribute anything to the political party, if you do any activity in the normal course of business that you do, or which benefits only your employees and their families, that is not going to be considered as CSR. Now, you have to do that CSR expenditure. Sometimes what happens is that the CSR expenditure exceeds, or you can say it is invested in such a project which is not completed in 1 year. So directly we cannot apportion the expenditure to that particular year. Maybe you have a requirement of 1 crore in a particular year as CSR expenditure, but you take up a project of maybe developing a school which requires a duration of 2 years. So in the first year you have spent only 50 lakhs, however you were required to spend 1 crore, but you could spend only 50 lakhs. Now what you can do is, for an such ongoing project, if the amount is not spent at the end of the financial year, within 30 days, you transfer that 50 lakhs remaining to unspent account in scheduled bank. Okay, it will be considered as CSR compliance. Okay, and it has to be undoubtedly used within 3 years. And if you have spent excess, then it can be set off also. Now we come to the next part, which is CSR implementation. Okay, how do you implement CSR? First is determining the thrust area. See, there are a lot of areas where you may go for your social responsibility. So you have to decide a domain. You have to fix a particular area. Okay, fine. This is the area where we want to contribute. Okay, where we want to spend money. So you have decided the target area. Thereafter you identify the project. Okay, in this particular area maybe we want to develop a particular school. So that is your project is we want to build a school. Then you evaluate the CSR project. Before making expenditure, you are doing that evaluation. What evaluation? That what will be the nature of the project, what will be the cost involved, the linking, who will get benefits of the beneficiary, how much feasible it is, feasibility from all perspective, what will be the time involved, how are we going to monitor it, will the impact of this particular effort of ours be measurable or not. So all that you are evaluating, right? After you evaluate, you go for implementation of the same. Now, implementation may be direct or through third party. See, we have certain specialized implementing agencies also. If we go or look at section 135, any CSR activity may be implemented by a company. You can form your own section 8 company. You can use section 8 companies. I am saying the broad term. Okay, we have in-depth things. I'm saying the broad term. You can form your own section 8 company. You can have the company or the registered trust which is formed by the government or act of parliament, and you can have other also. But if you are going for others, then they should have a track record of 3 years in similar activities. Okay, now there are specialized implementing agencies, like if I talk, there may be the panchayats or voluntary agencies, or there are self-help groups, a lot of Mahila mandals and all. So through them also you can go ahead for your CSR expenditure. Now, there are advantages as well as there are disadvantages of direct implementation. So if you go for direct implementation, it will be flexible. You will have a better supervision because it is being directly implemented by you only. So there will be quick decision making, less coordination, less cost. At the same time, you might not have adequate manpower, you might not have that domain knowledge, right? You might be biased towards a certain thing, you might not take corrective action, right? Maybe you have lack of monitoring, or you have lack of local area knowledge, you don't have that language is not known to you, right? So a lot of things may be creating problem also. If we go for third party implementation, again there will be advantages, there will be disadvantages. Advantages, there may be better supervision, there may be expertise, they may be unbiased, they have a single point of coordination, right? You can negotiate a lot of cost and you can cut down cost when you are hiring a third party for that, right? There are disadvantages also. What are the disadvantages? Disadvantages, maybe there is more supervision involved because it is not your direct thing that you're doing, right? Maybe they do not have that domain knowledge which you have. Maybe they are biased because they have a certain beneficiary to cater, they want to cater that only, right? Maybe they're not maintaining proper accounts, maybe they're not telling us the negative points, right? Maybe they're dominating a particular area, right? So there might be different problems also. Now, if I talk about implementation, there are internal and external problems which are being faced in the implementation phase, as in preferences deciding, mismatch financially, lack of seriousness, right people to work, you don't have them, internal references, differences in opinion. And if we go for external things, we have political pressure, we have social pressure, we have inefficient implementing agencies, or maybe they are diverting, siphoning money. This is a huge point which I'm diverting money or siphoning money. Siphoning money is a huge point, so I'm not getting into it right away. Fraud, there may be fraud involved. There is an NGO to which you have given 1 crore rupees, but ultimately they're not even working towards it. It is not ultimately going to a beneficiary. So maybe, so these are the issues that we face, right? Now we come back to the evaluation after making the expenditure. So we go back after making expenditure. How can you evaluate? So you can make a team of 2 3 officers who inspect the document, they make a report, right? And the report is placed before the CSR committee. It is recommended to board for approval, right? Agreement is made by the company and implementing agency for the execution and all that, right? Now, after you have completed this, the next step is monitoring, and monitoring should not be done at the end of the project. It should be done periodically, right? So you can assess the progress, how it is going on, and if there is any wrong thing which is found pre-hand, then you should take immediate corrective action. Thereafter, you have something called as impact assessment. Impact assessment actually helps you to know that whether spending so much of amount was worth it or not, right? So it should preferably be done by an independent third agency, right? Because you might be biased, you might be thinking, no, 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 it was helpful. Or somebody who has taken decision, if they are doing the impact study also, they will definitely say, yes, it was very impactful, it was very helpful, but no, ultimately maybe it was not helpful, right? So, and it should be focused on the impact only. It should be done immediately. If I take a particular session, if I ask you immediately, was it effective, you will say yes. But if I ask you around 15 days later, no ma'am, we hardly found any, because you tend to lose that memory. That memory fades away. You don't remember, okay, ma'am told me this, right? This was effective. So the same thing happens even in case of taking up a project, right? Whether it is effective or not has to be done immediately after the benefit is being given, right? And then we move to the last unit, which is actually a short one: sustainability management. So we have 3 approaches to sustainable development, which is social, environment, economic approach. Social approach is for the people, environment is for the planet, and economic is for the profit, which is also called as triple P, right? Triple P approach or triple bottom line approach, whatever you may call it, right? Now a manager has a lot of areas or a lot of steps that it has to undertake. The same goes for sustainably managing the company also. You have to identify the problem, you have to set the thrust for solution, you have to set a target, evaluate a project, select that project, plan action, use technology, innovate, schedule your actions, organize staff, directing, monitoring, corrective action, and review. The same thing goes here as well. Now, sustainability management or sustainable management is what? You are not compromising on the needs of future. You are fulfilling the needs of present, but without compromising the needs of future. That is something which is very important. So you have to maintain the quality of life on this planet, right? You should do such businesses, you should undertake such activities which are sustainable. If you wish to stay in the business, you have to ensure sustainability also. Okay, so this is something which is important. Sustainable management maintains the economic viability, it limits the resource depletion, it maintains quality of life on planet, company can generate more savings, and it can lead to better performance also. Thereafter, we also have something called as sustainability reporting, for which we also have read about ESG ratings. So there we have to, the listed entities have to give a compliance report on CG. There that is being incorporated, right?